The market as a whole was down 2.5%, but as you've heard, retailers were absolutely spifflicated thanks to the profit warning from Billabong. The big resources stocks all fell between 2.5% and 3.5%, and the banks lost around 2%. AMP fell nearly 4%. The scare du jour? Fitch Ratings Agency warned on Friday of big downgrades of all European sovereigns because it said a comprehensive solution to the crisis is beyond reach. Asian stocks were also marked down today heavily, none more so than South Korea because of the new uncertainty caused by the death of the North Korean leader. Otherwise, markets there fell by about the same as ours. Wall Street actually closed a bit higher on Friday and European markets were relatively calm, but we'll see how they go tonight. The Australian dollar was down a bit today, but it's actually being held up by the buying of Aussie government bonds, which I mentioned last week. Today, the bond yield fell to 3.73%. Which is a new low, although as I've learnt, it's not an all-time low. It's just the lowest since 1951, as this chart provided by Perpetual Today shows. The current rate is only 0.75% above the record low that happened in 1941, just after the bombing of Pearl Harbor by the Japanese. My second chart tonight is designed to put the European debt crisis into context. It's the spread between LIBOR, or the London Interbank Offered Rate, which is the rate at which banks lend to each other, and the overnight indexed swap rate, which is the more stable interest rate benchmark. Now, it's complicated, but this is the key indicator of banking stress. 2008 was all about American banks, as you can see, and this time, of course, it's about Europe. But it's not yet as bad. We're in about 2007. And that's finance.